panel before we go to the coffee break. We're talking now about SME lending and whether SME lending is going to mature from the small business funding model to one where it's going to be MME lending, medium-sized and mid-range businesses. Does that rub up against competition with banks? At what point is there scale, and what are the challenges that we face as we go into more of a mid-market model? I'll ask our panelists just to introduce themselves and say a quick word about their business, and then we'll get into the questions.
Okay, I will start. Sorry. Niels Turfboer, Managing Director from Spotcap. We're an SME online lender, global. I will touch upon it a little bit later. We started out, I think, is a little bit the same as Patrick. We figured the smaller companies were the most underserved. We actually quickly found out that's not the truth. So we moved to what I would say for part of our business to the lower mid-market. And that's the reason why we're in this panel.
Kindert. I am from NN Investment Partners. We are managing approximately 22 billion assets in several strategies, ranging from mortgages, commercial real estate, infrastructure loans, corporate credit, and commercial. Anyway, I forgot. Anyway, we have 7 different strategies. But what is important here is that our portfolio represents actually a mix of everything. So we look at value, we look at origination, and sometimes I'm directly investing in corporates, sometimes via a bank, and sometimes via an investment fund. So we look at the different exposure we want to have access to, and then we decide, okay, is it going to be that we are directly investing in, or with a bank, or with a platform? So that's about my strategy.
Stuart. Is working. Stuart Law, co-founder of Assets Capital, 5 years in. We're a mid-market lender, in our view. So our sweet spot is between 200k and 2 million, but we've lent from 100k to 10 million. We're secured only, so we're property-backed entirely as of today. We have around 100 staff, profitable, cash flow generative, and cover bridging, commercial mortgages, and house building development type finance.
Yeah, hello, good afternoon. Tim Thabe, co-founder and CEO of Credit Shelf. We're Germany-based, started in 2014 as a business-to-business marketplace lending platform. So we don't distribute to retail. We lend to mid-market, so Mittelstands companies from 2.5 to 100 million euros worth of revenue, from 100k to 5 million. Our average ticket size is around 500k and growing. And yeah, it's a very interesting topic. I'm looking forward to it. It's something we started deliberately and we haven't changed. So we wanted to target larger companies, and we found the same thing, that if you look at it from a bird's eye view, we will see it's overbanked, but there's still lots and lots of things to do.
So I'll start with a basic question, and you know, from my perspective, so I'm Brian Korn. I'm a partner at Manat Phelps, which is a law firm based in the United States. Great to be here in London, by the way, and we have a 6-continent fintech practice specializing in companies that are investing in or originating through U.S. assets. We also do work on European capital platforms as well. We know that the industry has sort of grown up in parallel with the consumer platforms, and the consumer seems like it's a much quicker underwriting process. You can get an approval in seconds. And the small business platforms in both the main European markets as well as in the US have really grown up from a small size up type platform. There are very few platforms that are operating in Stuart's space or even larger, and we have a few clients that are trying to be arrangers of loans in the 5 million to 10 million space. But I guess why has everything started on a small side in terms of the online finance world?
Maybe if I can take this one, I think most businesses will start hopefully with a solid analysis of the market. And I think on the lower end, it was very transparent. There was a funding gap. The mid-market might have been a little bit less transparent, and as it is in some countries very heavily banked, it looked like there was less of an opportunity there. When we entered into our markets, and again, there's some differences between the regions where we operate, but quite quickly we actually understood, depending on how do you deliver the product, what kind of product you have, a lot of the clients that actually have a bank still are in search for other types of funding. So for instance, in our portfolio, we very quickly moved away from anything to do with the smaller part of the S's, and roughly 90% of our clients currently will have a banking product in their portfolio.
Anything else, Stuart? I guess why has the industry started small and now seems to be growing larger?
I think investor base is one reason. It's easier to fund a £20,000 loan than I think our second loan was £1.5 million. So we had an existing investor base we could plug into. That helped a lot. Our average loan size is around £1 million or so. We've lent 500 million, and it's really tough if you don't have that investor base. So it's an area that works as well. I mean, you say it's overbanked, but I'd say it's the opposite. I think that space between a few £100,000 and getting towards 10 million is actually quite a difficult space. Banks get interested at 10 million plus, and the online lenders are going to do very well over time in the sub 100k, sub 200k zone, more unsecured. Mm-hmm. It's hard work in the middle. You've got to visit your customers, you need some infrastructure, you've got to apply the tech part of fintech in different ways. You can't just automate credit on a £3 million loan to somebody you've never met and no idea if the premises exist, genuinely. It's a different model.
And I guess, Gabriella, when you look at investments, are you more attracted to a lender that may have fewer loans but at a higher ticket size where you know there's been a lot more underwriting work and a lot more due diligence? Or are you thinking that data is really running the show, and as long as I have a borrower who's in a has a solid credit underwriting model, that I'd rather have fewer smaller loans than a few large big ones where if one of them defaults, then there's real trouble in the facility.
Okay, we are looking at value. So, and how can I exploit this value? So, exploiting the value and having access to these companies are very different when we talk about a company which is 250 million turnover or 5 million turnover. Yeah, so direct lending and corporate lending is a very complex world, and for many investors, actually, the most known is the private debt, which is financing highly levered companies via private equity sponsors. There is a huge range of different companies next to this. Yeah, so the SME lending, where our preferred choice was to exploit it via banks. Or sometimes via on our own. So we have companies where we directly lend to. We have partnership agreements with certain banks. And it's only now that we are looking at direct lending platforms. And the simple reason why, we don't look at tickets below 200 million. So in order for me to look at this, I should be able to find the right platforms. And some platforms already got to this level. And I see this as a completely different underwriting principle. Meanwhile, in the direct lending 1.0, you look at bottom up, you look at alpha by credit selection. Here is more like a beta. So the average size of the lending of funding circle is 7,000, I guess. My average lending size is 25 million. Yeah, so it's a very different approach. So I try to limit the cost of the platform via reducing the cost, actually, because if you look at the complexity comes from a very different angle.
Interesting. So do you expect that there will be even fewer platforms in the future? Are we past the beginning where there aren't going to be a lot of new names in the space, and it's really the maturing and the strengthening of the existing platforms? Or do you think that there's still opportunity in pockets, either on a product basis or on a geographic basis, for more expansion?
I think it's a fascinating area, and especially when you look at the smaller SME and consumer lending, that's where the data advantage can come into play. That's where you can actually have a lot of data, speedy processes, fast execution, and the beta play. And there, I can already see platforms that have gained access. They will have data advantage. So I do feel that there will be 1 or 2 platforms per market which will dominate actually the certain geographies.
Right. No, it's interesting because some of the things we're seeing in the States is you have the mature platforms, so Funding Circle is one of them, On Deck, Cabbage, and then there are a number of platforms that many people haven't heard of that operate in the secured space or the payments or the processing or factoring space. And so, layer that upon geographic arbitrage, which is also rampant within the U.S. Because each state has its own regulation. It's quite interesting, although nothing like what we have in Europe, where you have multiple cultures, multiple languages, a similar regulatory environment, but obviously the banking environment in terms of which banks dominate in each country are a little bit different. Tim, I guess, can you comment a little bit about what it's like to be a startup SME lender in Germany and how that looks compared to, say, what your peers are going through in other countries?
Yeah, well, I guess in Germany, the development is probably a few years behind the curve, and compared to the US for sure, compared to the UK as well. So I think the first step is to really make sure that people understand what you're actually doing, right? You have to educate a lot. So we're going around educating clients, educating multipliers, advisors to tell them what's actually possible and what's out there. So it takes a lot of time to do that, but at the same time, it's a blue ocean. There's nobody else doing it at the moment, and Lendix is coming to Germany at some point this year, but we believe the market is huge. There's a lot of opportunity. If you look at it, as I said, bird's eye view, there's 1,800 banks in Germany, so you ask yourself, what the hell are we doing there? But if you look at it more closely, they're all chasing the same business, which is secured lending at 2 or 3 or 4% to companies that they need that, of course, and all of our clients have bank lending in their balance sheets, but they also need additional funding for working capital purposes, for other purposes that the banks are not willing to give anymore, at least at the same rate that they used to. And if from a client's perspective, the next best alternative is to go to a factoring company or to get supplier credit, which is probably double digits or even more, 24% if you think about it, 2% a month. So that's a huge gap. But to make people aware that, first of all, that there's an alternative, to make them aware what they're actually paying for some of the funding that they have currently, and then to educate, and then basically to build the market.
I guess I'll just open this up to the panel. Do you think that there's a large area of untapped opportunity within Europe? What do we think the total European market size is? Or do we think we're going to see a few platforms do very well in certain countries, but not necessarily cross borders and do well in other places?
I think it's one of the companies that is in 3 countries in Europe and 2 on the other side of the world. It's quite complex. I think the market size is there. I do see that in a lot of the markets where we are, there is a lot of competition. I do expect that there will be some filtering out of some platforms. At the same time, there is no very structured form of uniformity in Europe, neither in culture, neither in regulation, neither in, let's say, the cap on interest. So it's not as easy, I would say, to go into multiple jurisdictions. I think it's very, very cool what Lendix is doing, adding 2 countries a year. I think it's a big challenge.
It's actually an interesting question with regards to market size, because the first things we did when we started this, the idea of Credit Share was to look at market data and to see what's available in terms of research, and it's not a lot, right? You will find a lot of data on bank lending, but the way the ECB cuts it or the central banks cut it, but it's not really by client size or by demand. So it's really difficult to really gauge the data. I think the one thing we know, it's huge, right? But it's very difficult to pinpoint it. We have an idea what it is in Germany. I would say it's a triple-digit billion euro market for SME loans.
Yeah, I think we can relate to this number. If you look at S&P and McKinsey, how big the funding gap was, what they predicted, what they said a couple of years ago, they said 1 or 2 trillion. And if I look at the balance sheet of the European banking sector, it's 30 trillion. So I think it does make sense. However, I think we should be realistic about this, because I do feel that, if you look at what happened between 2008 and 2013, the banking sector balance sheet has reduced by 7 trillion. I see this drop stagnating and even increasing. So banks recovered. I think right now it's a lot more about re-establishing profitability for the banks, and I think a lot of banks actually suffer from excess liquidity. Where I see a huge opportunity is actually the S&M segment, where the data advantage and the access, the origination network can be very different than currently serviced by banks. Banks cannot service profitably these sort of small companies. And if I look at Germany, for example, there are, please help me here, I think 4 million Mittelstand companies.
3.4, yeah.
Yeah, indeed. 70% of the jobs depend on these. And let's say 800,000, so 20% will have exchanged owners. So huge opportunity for direct lenders as well in different segments. There will be some in the M segment, there will be some in the S segment as well. So there is a big enough cake, I think, for everybody.
Yeah. And also on the investor side, because investors can access 1% of the population, not in terms of volume, but in terms of numbers. So there's at least 50-60% of GDP worth of companies that you can't access as an institutional investor today.
If I can add one thing, because I always hear this, banks cannot make this segment profitable. And reality is, I think a lot of fintechs cannot do that either. But we're never addressing that, because the things that fintechs suffer from most is the cost of capital. Let's assume they all have the risk in control. But they pay triple as much as a bank will do. So it's not that it's that easy for fintechs to make it profitable either.
I would tend to disagree with that, because I think the existing origination network of a bank cannot make it profitable. I think if we change our mindset and if we think that, okay, how can we do origination underwriting via digital platforms, we can. And banks can and will be able to do. So from moving from a alpha to a beta play. So it's all about the digital transformation, how you facilitate, what sort of origination infrastructure you will have.
Can I? Sorry, last comment. I like this. I like this discussion. Yeah. The reality is, at least the clients we target, you either pump in a lot of marketing money, or you find the more traditional ways of originating, because the client that automatically comes to you and types in, "I need an unsecured loan of £400,000," is usually not the client we would give a loan. So it is a nice thing to say, digital strategy is much more efficient, but even there you hit the same roadblock as a lot of traditional players do.
Maybe we should change our mind who will be the best position to banking in 2025, because if I look at PayPal, if I look at Amazon, if I look at Ant Financials, the market share they are gaining in consumer lending and SME lending, I find it completely shocking.
But that's the small end, isn't it? That's the small end of the market. I think in the mid-market, it's very difficult. We're one of those few profitable peer-to-peer platforms, have been for 2 years now, doubling profits each year. And it is possible. If you've got a real model, you can make money and still pay away market-leading rates, which fortunately AltFi data have looked at. I think in terms of those stats, though, it's interesting to hear the numbers in Europe, because in the UK, up until about 2015, in the prior 3 years, from memory, I think the banking system took out of SMEs, took out, I think it was 3 billion, 5 billion, 7 billion of funding, not in that order, out of loan funding, loan and overdraft funding into those small, medium-sized businesses. It then gradually recovered a little bit for a couple of years, but last year was back down to just 600 million net lending going into SMEs, and the first month of this year alone was minus 765 million. So it looks like Brexit vote has triggered a very substantial reversal again in the UK banking appetite. And it's partially that and partially giving up on the expense of servicing multi-million pound businesses or less with people on the ground. They're giving up on that, and individual banks are moving hundreds of thousands of SMEs into telephone banking. So there's this huge gap left for businesses who can profitably deploy face-to-face meetings, which I believe you need for big loans around the country, and use tech to make sure that those expensive people are spending most of the time in front of customers, and then also use it to bring down your cost of capital, which is a more complicated subject.
I guess at some point you hit the bank ceiling, and the banks, when we started in this industry, we were thinking, geez, I really hope the banks don't find out about this because they'll make a few phone calls and we'll be out of business at 3 o'clock. And that has rapidly turned from a partnership model where a lot of banks are dabbling in fintech. Most big banks have a head of fintech and show up at conferences, and we don't really know what they do or how they fit in or integrate with the big banking system. But we have seen banks start to make acquisitions or either start their own models or a build it or buy it type structure. Are you predicting more partnerships with the bigger banks as you get, Stuart, specifically higher into the middle market?
Yeah. I mean, we've had a partnership with RBS for some time, but do partnerships function in that way? I'm not convinced. It's the motivation on the ground. Are the people on the ground really passing over those leads? And have the government portals been a success or an utter and complete failure here in the UK? I think anybody close to it knows the answer to that. So there has to be another way, and that way is looking like banks going down the low-cost origination route with telephone banking. You either fit the model, you fit the tick boxes, or forget it. And then where do you go? If you're small, go to the funding circle types and that online credit model, that works well. But if you're bigger, then it's getting really tough. If you need a multi-million loan for something and you've got some security, who do you actually talk to? And it's clear that the banks are going into negative funding, but alternative finance, which is why we're here today, and it's not just peer-to-peer lenders, those guys are providing all the growth capital. The banking system is just the foundation capital, keeping the lights on in the country.
Right.
It's the alternative finance that's providing the funding for growth of GDP, etc.
Well, I think we will see more partnerships. I mean, there's three things that are difficult, and each three can happen, right? You can have more partnerships that are difficult to implement. The banks can try to build their own models, which is difficult to do, and a lot have tried, and not very many have succeeded. And you can have fintechs trying to do it on their own, which is difficult as well. So I think the most likely of the three is smart combinations of banks and fintechs, and they're difficult to get to work. I agree with that, but I think that's the way to go because it makes the most sense of the three options.
So we have a question. Is there too much money flowing into alternative credit, private debt too quickly? Anybody want to tackle that? Too much money.
I'm not convinced.
Not enough money.
Depends which part of lending are we talking about. So we just said, in my area, I have 5 different departments and 8 different strategies with very different drivers, very different complexity, very different liquidity. So ranging from private debt backed by private equity sponsors or small SME lending or CRE lending. And trust me, all have different supply and demand characteristics. So in some segment I see oversupply. Good example for that is Schuldschein lending in Germany. In others, I still huge opportunities still.
And are there, it seems like the financing partners are sort of selecting who the winners and losers are going to be, because if you're starved for capital, you're obviously not originating new loans. We have certain clients who have funds that are oversubscribed because a few fintech celebrities have stepped up to join in. Everyone says, oh, that person's investing. I don't need to see the papers. Just sign me up. And then others that write almost the same credit box and are not getting the funding. So it seems like there is a shaking out now of winners and losers, at least from my perspective. I don't know if you guys agree with that.
Yeah, there's definitely a shakeout going on. It's sort of who makes it over the top of the hill and who rolls back down to the bottom before they do. And that's definitely what's going on in the market. And you're right, I think a lot of it might be to do with funding. I think people assumed institutional funding would just turn up automatically, and it's a lot tougher than that for so many reasons. And it's about getting critical mass and having quality data.
Yeah, I would like to add to it. Indeed, we are facing a regulatory transformation where banks have no idea how, for example, Basel IV will affect them or what will be the impact of IFRS 9 and all kinds of regulation. And we are facing a digital transformation. So it's an industry in a complete identity crisis. I mean, if I told you like Goldman Sachs will start a consumer lending segment like Marcus a couple of years ago, you would think I'm a lunatic, yeah?
Right.
And there are truckloads of examples for this lunatic syndrome.
And they started and they were in last place, and now they have their own funding sources, and they've acquired Bond Street, which does SME lending, and it's and now they look like the real model. One of the questions, interesting. How do you target mid-market borrowers at scale? Right? How do you profitably underwrite multi-million pound or euro loans?
Yeah.
And do it in a way that you're not spending a ton on origination costs.
From our end, it's just a lower mid-market, but I think it will relate to bigger tickets as well. I think there's a lot you can do in the automation of the actual data gathering, the processing of data. Obviously, the underwriting itself is a little bit more complex. Usually, the companies are more complex. You have to look at things that is not that easy to fully automate. But we, for instance, build a completely digital front, mid, and back office, and that obviously helps to do this in a scalable way.
Yeah. And I think there's probably two aspects. I think one is how do you address them in the first place, right? It's a difficult problem because there's too many of them to go individually, and then there's not enough to go on mass marketing. So that's why we chose to go via multipliers. And the second part is how do you apply your human resources that are really expensive at the right point of the funnel, right? So you have to have a filter. You have to select probably automatically what you want to take a closer look at. And then we still believe that you need to have a pair of real eyes on them before the money goes out the door. So I think you have to time that in the right way so you don't look at things that you eventually end up not doing.
So Tim, every loan has a real face-to-face meeting before it's completed?
The larger ones, over 250,000, we go and see them on site. Below that, we'll typically have a call with them, but every loan decision is made by a human being in the end on the basis of data that we have enriched and filtered and screened automatically.
Now, do you guys require audits for financial statements?
No. We believe that we have a better way of finding out if they're doing the right thing or not.
And then the last question is, what's the right balance between automation and manual underwriting for mid-market loans?
Automation of administration, manual underwriting of credit.
Gabrielle?
It depends what is the cost of operation. Because if the cost of operation is 200 basis points or 5 basis points, it's a completely different answer.
And obviously sometimes you'll write a loan you shouldn't, and it works out okay. And other times you agonize and feel like something's going to work, and it doesn't, right?
Yeah.
Oh, we have seen it, yeah.
I guess the way we look at it is we don't want people to spend time looking up data, going through files, scrolling through PDFs. I think this is stuff that you can actually automate, but at the end of the day, the decision has to be somebody's.
Okay, I'd like to thank our panelists for joining us. I think we're going into the break now, and then we'll come back. Thank you.